The 2019 FSI's guide recommends, consistent with IFRS 9, that an entity recognizes a financial asset or a financial liability in its balance sheet or statement of financial position when, and only when, the entity becomes party to the contractual provisions of the instrument. An entity derecognizes a financial asset when, and only when, the contractual rights to the cash flows from the financial asset expire, or it transfers the financial asset to another entity. On derecognition, the asset is removed from the balance sheet or statement of financial position. An entity removes a financial liability from its balance sheet or statement of financial position when, and only when, it is extinguished. A liability is extinguished when the obligation specified in the contract is discharged, cancelled, or expires. The term valuation used in the 2019 FSI's guide corresponds to the IFRS concept of measurement. Measurement involves assigning the monetary amounts at which assets and liabilities are to be recognized and carried on the balance sheet or the statement of financial position. At initial recognition, an entity generally will measure or value an asset or a liability at its fair value plus or minus directly related transaction costs. There are specific cases in complex transactions that involve variations from this general approach. Compilers generally rely on supervisory data sources and will not have to address these special cases themselves. If needed, detailed guidance can be found in the text of IFRS 9. At initial recognition, instruments are classified in accordance with IFRS 9 into one of three categories. Those to be measured at amortized cost, or AC, those to be measured at fair value through other comprehensive income, or FVOCI, those to be measured at fair value through profit and loss, or FVTPL. The measurement or valuation rules applicable to each category determine the process for the measurement of subsequent changes in value of those instruments.